Hello value investors, thank you for joining me. Today I want to talk about Netflix and why I believe that Netflix is attractively valued. If you haven't done so already, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own. I'm particularly focused on small cap stocks. That's what I believe my edge is. But Netflix is the type of stock that I would consider if you're slightly smaller. But there's still a lot here that's worthwhile discussing. So let's get on it. So we're going to talk about Netflix has actually underperformed, so we're going to address that slightly. We're going to talk about its revenue growth rates and what that's going to kind of stabilize that. Then we're going to talk about Netflix as a cash flow story. Finally, we're going to bring that all together and talk about it from its valuation perspective. So just before we get jumped in, it's quite interesting that Netflix is actually over the past year has actually underperformed the Nasdaq. So it's quite rare Netflix underperforms. And what I find quite interesting is that when the whole work from home trade was happening, Netflix was one of the first companies that really bounced out of that. But in the latter parts of the year and even coming in 2021, it's kind of really just fizzled out a little bit. Not a lot, it hasn't given back all the gains, but it's fizzled out a little bit. So I think that's quite interesting. Anyway, so let's get started. So there are so many different people saying different things about why Netflix is not really a strong performer right now. So you've probably heard the economy is reopening, or that the people are churning out of Netflix, or that the content slate that Netflix is putting out is a bit too light and people not really being compelled enough to subscribe to it. So, and I'm not really buying that too much. I do think that there is the possibility that the likes of Disney Plus and the Amazon Prime and Discovery tying up with AT&T's media platform, those kind of things could be having some kind of role here. But ultimately, I think that this is kind of been blown out slightly. Because if you look back, right, to how Netflix was performing this time last year, Netflix was growing at approximately 25%. So that's the kind of ballpark we need to be thinking about, right? So the guidance for this quarter up here is 19%. So it is a slight dip, okay? But it's not the end of the story. And I think that a lot of that has to do with the number of subscribers that Netflix pulled in might have had a bit of a jump, a bit of choppiness coming out of COVID, and it might be that the likes of Disney Plus have some impact here. But my point is that households that subscribe to Netflix are not going to be churning out. I think that Netflix is going to be the de facto leadership platform that households are going to subscribe to, and then they may subscribe to 2 or 3 perhaps different viewing platforms on top of that. So I think that many households will just adopt Netflix as their streaming platform if they haven't done so already. And on this fact, I think that Netflix actually has a lot of pricing power. If you own Netflix and Netflix was going to say to you, okay, next year or in the coming 6 months, we're going to increase the pricing of your subscription by 12 or 15%, that wouldn't be the reason for you to unsubscribe. If you are subscribing to Netflix, you just press that go. You're not going to really think. So that's a lot of pricing power, because it's such part of people's routine right now that I think that in and of itself could add about 15% year-over-year revenue growth rates. So you just need approximately 5 or 6% coming in from new subscriber growth. So I think that the point here is that you're going to have a lot more pricing power than people expect. And this is what I'm going to come to next. So Netflix is now turning into a cash flow story. And I think this is quite attractive, because if you raise prices, you don't need to have a raise in operating expenses. So you can just raise prices on the top line, and that pretty much just falls to the bottom line as cash flow. So Netflix's balance sheet right now is as strong as it's been for a long time. It's approximately 15 billion of gross debt. So they've said that they want to keep that gross debt at approximately 10 to 15 billion, and whatever they are making in terms of excess cash flow, they're going to look primarily to repurchase shares, possibly do some M&A. But they're quite open. So they've done repurchases in the past, and they're quite happy to do repurchases if they think that the price is attractive. So I think the price is attractive. I don't know about them, but right now, let's say for the sake of discussion, you got a bit of pricing power coming in approximately 13 to 15%. You have a bit of subscriber growth coming in about 5 or 6%. So you're kind of looking at a compounded annual growth rate 20%. So you have a company that's potentially growing at 20% over the next 2-3 years. Obviously, they do have their costs, but this is just going to be the run rate of the business going forward. And right now, this year, it's priced at 8 times forward sales. So 8 times forward sales is not particularly expensive for a company that's so ingrained in consumers' expenses. Consumers are just used to paying for Netflix just as they pay for electricity, just as they pay for their broadband. So I think that it's quite a lot more stickiness than people actually think about. People don't really realize how much stickiness and how much pricing power Netflix has. So we kind of just touched a little bit about the competitive landscape, but we primarily talked about its revenue growth rates, its cash flow story, share repurchases, and its valuation. As always, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks that I own and what I'm looking at right now. Thanks, see you soon.